The Fed has a lot to think about. That's our topic for this morning's Backstage Pass. Good morning and happy Friday. I hope you've had a great week so far this week. Stocks are up sharply so far this morning, and mortgage bonds are up just a little bit. Stocks are up on better than expected retail sales data that came out today. Retail sales rose by 1% in the month of June, and the expectation, the forecast was 0.8%, so stock market is reacting favorably. So far, the bond market hasn't reacted negatively. That's kind of what was expected, was a negative reaction out of the bond market on that news. But they haven't. As a matter of fact, mortgage bonds are up 13 basis points and the 10-year yield is down 3 basis points so far this morning. What that means for mortgage rates are going to open up a little bit better than they were yesterday. And if you remember yesterday, we opened up very, very worse. Mortgage bonds were down very sharply yesterday, but kind of retraced their steps, and we had some repricing for the better towards the end of the day yesterday. So that's what's going to happen so far this morning. We'll see what mortgage bonds do throughout the day and if they decide they want to assimilate that retail sales data in a different way. But really what's going on is that the mortgage bonds and the bond market's trying to figure out what is the Fed going to do here in a couple weeks when they have their next meeting. So it's already a given. Everybody's expecting for the Fed to raise the Fed fund rate by 50 or 75 basis points, but some are wondering, will the retail sales be enough to raise it by 100 basis points? Will that be enough to push the Fed to raise it 100 basis points? And that's kind of what the markets are looking at and really trying to predict. Another thing that's going to be weighing on the Fed's mind is the jobs market. So initial jobless claims came in. They were 9,000 higher for the week of July 9th, up to 244,000. And the 4-week moving average is at its highest level in December. So a little bit of weakening in the jobs market, and that's going to weigh on the Fed's mind as well. So here in the next few weeks, the Fed has a lot to think about, and really it might be a bumpy ride for mortgage bonds in the bond market because they're just trying to predict, the market's trying to predict, what is the Fed going to do? So we'll see what happens and just let you know and keep you informed as it's happening. Now, in other news, CoreLogic released their loan performance insight data, and that showed that houses or homes with mortgages that were 30 days or more late ticked up just a little bit from 2.7% to 2.9%. Homes that were seriously delinquent or 90 days or more late stayed even at 1.4%, but we could see that rise in the next 60 to 90 days because that 30-day late number went up. And then homes that are seriously delinquent and in foreclosure went from 0.2% up just a little bit to 0.3%. But still, overall, loan performance is very, very, very healthy in the United States right now. And really, it's being protected by the amount of equity, home equity that is out there just off this past year that we've talked about before, the 20% appreciation that we've seen. Now, that's all the news that we have for today. I hope you have a great weekend. And listen, be sure to comment, like, subscribe. If you have any questions, leave a comment. We'd love to answer questions. And don't forget, stay positive. Have a great weekend. We'll see you on Monday.